If you had $10,000 and needed to turn it into $1 million, would you prefer to spend 8 hours a day staring at flashing red and green lights on a computer screen, or spend just 5 minutes a month clicking a button and then going for a walk? Many people mistakenly believe that trading and investing are the same, but choosing the wrong one can quickly lead to losing both your money and your peace of mind. Today, we will break down the realities and lifestyles of two different individuals to see which path truly builds wealth in the modern world. To illustrate the significant difference between these two approaches, let's examine the lives of two brothers, Jason and David. Both inherited $20,000 from their grandfather with one instruction: use this money to change your life. Jason is young and energetic, drawn to the idea of quick profits, so he decides to become a trader. David, on the other hand, is calm, focused on his career, and prefers to think in decades rather than minutes, leading him to choose investing. Their journeys over the next 5 years will reveal important insights about how money moves in the markets. Jason begins his trading journey by setting up a high-tech home office complete with 3 monitors. He spends his nights studying technical analysis, candlesticks, and moving averages. To Jason, the stock market is a battlefield where he can outsmart others to secure profits. He is not interested in what a company does. He is solely focused on price patterns on a chart. If a stock's price is rising quickly, he buys it. If it begins to drop, he sells immediately. He seeks to make small, frequent gains throughout the day, hoping they will add up to a substantial income. This is the essence of trading, a high-activity profession centered on short-term price fluctuations. In contrast, David adopts a much simpler approach. He opens a basic brokerage account on his phone and spends an afternoon researching the 500 largest companies in the United States. He believes that over the next 30 years, the American economy will likely grow. He invests his entire $20,000 into a low-cost S&P 500 index fund. He doesn't buy multiple monitors or learn technical patterns. In fact, he deletes the app from his phone to avoid the temptation of checking it daily. This embodies the essence of investing, a low-activity strategy based on long-term growth and the fundamental value of businesses. 6 months into his journey, Jason is feeling exhausted. He has made some incredible trades, earning $2,000 in a single morning. Those moments felt like a high, making him feel like a genius. However, he has also experienced days where he lost $3,000 before lunch. As a trader, Jason's emotions are tied to every tick of the clock. When the market is volatile, he struggles to sleep, constantly checking his phone during dinner and at his kids' soccer games. He essentially has a high-stress full-time job where his boss is a random number generator. The biggest challenge for a trader like Jason isn't just the math, it's the discipline. Trading requires you to be right twice. You must know when to enter a trade and exactly when to exit. If you stay too long, you risk becoming greedy and losing your profits. If you exit too early, you could miss the big move. Jason realizes that he isn't just battling the market, he is also fighting against his own biology. His brain is wired to feel pain when he loses and euphoria when he wins. And both of those emotions can lead to poor decision-making. In contrast, David is having a very different experience. During the same 6 months, the market dropped by 10%. Although David saw the news headlines about the market crash, it didn't bother him. As an investor, he knows he isn't planning to sell for another 25 years. To him, a market drop is just a sale on the companies he already owns. He doesn't feel the need to be right twice. He only needs to be right once, when he decides to buy great companies and hold them forever. His stress level is 0 because his strategy doesn't require him to watch the scoreboard every minute. As the years pass, the differences in their methodologies become increasingly apparent. Jason becomes an expert in technical analysis. He focuses on identifying support and resistance levels and employs complex tools like the Relative Strength Index and Fibonacci retracements. Jason believes that human psychology manifests in patterns on a chart, and if he can identify these patterns early, he increases his chances of success. Essentially, he operates like a professional gambler, using data to slightly tilt the odds in his favor. In contrast, David emphasizes fundamental analysis, albeit in a more passive manner. He isn't concerned with chart patterns. Instead, he focuses on factors such as earnings per share, profit margins, and competitive advantages. When examining companies like Apple, Microsoft, and Amazon, he poses a straightforward question: will people still be using these products in 10 years? If the answer is yes, he chooses to remain invested. David understands that in the short term, the market acts like a voting machine driven by popularity, but in the long term, it functions as a weighing machine, reflecting actual profits. One of the most important lessons Jason learns is the impact of friction. Because he is trading stocks every day, he constantly generates tax bills. In the United States, if you sell a stock that you held for less than a year, you pay short-term capital gains tax, which is the same as your high-income tax rate. Every time Jason makes a profit, a significant portion of it goes to the government at the end of the year. Furthermore, even though many brokerages offer commission-free trading, there is still a bid-ask spread. Every time Jason buys and sells, he loses a small fraction of his money to market makers. Over thousands of trades, these tiny costs accumulate into a substantial amount of lost wealth. In contrast, David experiences almost no friction. Since he hasn't sold a single share in 5 years, he hasn't paid any capital gains tax. His money can compound fully without interruption from the IRS. Additionally, he doesn't incur costs for data subscriptions or expensive trading software. The total cost of his investment strategy is essentially zero. This is a secret that many professionals won't reveal. Often, it is more profitable to do nothing than to do something. Before we look at the final results, we need to address a concerning statistic that Jason eventually discovers. It is known in the industry as the 90-90-90 rule. This rule states that 90% of retail traders lose 90% of their money within the first 90 days of starting. This occurs not because the traders are unintelligent, but because of a professional barrier. When Jason buys or sells a stock, he isn't just trading against amateurs. He is competing against billion-dollar hedge funds, high-frequency trading algorithms, and PhD mathematicians who have access to data milliseconds before he does. For Jason to win, a professional on the other side of the screen generally has to lose. This makes trading one of the most competitive professions in the world. David's path is different because he isn't trying to outsmart the professionals. He is simply participating in the overall growth of the economy alongside them. When a major company like Microsoft succeeds, the hedge funds benefit, and so does David. He isn't competing for a slice of the pie. He is simply owning the bakery. By accepting the average market return, David outperforms the majority of professional fund managers who attempt to outsmart the system. This represents a paradox of finance. The less you try to outperform others, the more likely you are to succeed over the long run. The power of compounding. By the 5th year, the brothers sit down to compare their results. Jason has experienced some significant wins. At one point, he turned his $20,000 into $50,000. However, after accounting for his losses, the stress he endured, trading software fees, and hefty tax bills, his account now sits at $28,000. While he has made a profit, he realizes that if he calculates the thousands of hours he spent on trading, he would have actually earned more money working a minimum wage job at a grocery store. David's account, on the other hand, has grown steadily. He hasn't experienced any 20% gains, but he also hasn't faced any 20% losses. Through the power of compounding and dividend reinvestment, his initial $20,000 has increased to $34,000. He put in no effort, faced no stress, and yet he has more money than his brother, who treated trading like a full-time job. It's crucial to discuss risk management as well. Jason's strategy involves high leverage and high concentration. If he makes a single significant mistake, or the internet goes down at a critical moment, he could lose his entire account within minutes. He is playing an all-or-nothing game. If he is wrong about just one trade, he must work twice as hard to recover to the break-even point. This is the ruin risk that every trader must confront. David, however, faces systemic risk. The only way he could lose all his money is if the 500 largest companies in America simultaneously went to zero. If that were to happen, the world would have far more serious problems than a stock market portfolio. Because he is diversified across every sector of the economy, he is safeguarded against the failure of any single company. His risk is managed simply by the fact that he owns a piece of everything. Which path should you choose? Choosing between trading and investing goes beyond just financial considerations. It also involves your personality and your goals. Trading may be a suitable option if you have a high risk tolerance and genuinely enjoy the process of data analysis. However, keep in mind that trading is a skill that takes years to master. Much like becoming a doctor or lawyer, it is not a shortcut to getting rich quickly. Rather, it is a way to work for yourself in a high-pressure environment. You should choose investing if you value your time and want to build sustainable long-term wealth. Investing is the best path for 99% of the population because it allows you to grow your wealth while focusing on your career, family, and passions. It leverages the work of the world's best CEOs and employees to make you money while you sleep. The hybrid approach, the best of both worlds. Some people opt for a middle ground. They allocate 90% of their money into safe, long-term investments, like David. This represents their boring wealth that they never touch. The remaining 10% is used for fun trading, like Jason. This strategy allows them to participate in the market's excitement without jeopardizing their financial future. The core and satellite strategy is a favorite among professional wealth managers because it balances safety with the potential for higher returns. Next, we must consider the vacation test, which highlights the lifestyle difference between a trader and an investor. In year 4, both brothers decided to take a month off to travel through Europe. For David, the investor, this was easy. He didn't even check his brokerage account. While he enjoyed pasta in Italy and hiked in the Swiss Alps, his investments continued to work for him. Millions of people were still buying iPhones, subscribing to Amazon Prime, and using Visa cards. David's wealth grew every single day he was on vacation because his income was completely decoupled from his time. For Jason, the trader, the vacation was a challenge. His income was generated by his active participation in the market, so the moment he stopped clicking the mouse, his income halted. Even worse, the stress followed him. He found himself waking up at 3 in the morning in Paris to check the opening prices in New York. He couldn't truly enjoy the sights because he was worried about missing a significant market movement. This emphasizes the hidden truth about trading. It is an active job, not a passive investment. If you aren't at your desk, you aren't making money. David realized he didn't want to build a cage of gold for himself. He wanted to create a machine that would give him his time back. The most important thing to remember is that the market does not care about your effort. It only cares about your results. In finance, working harder does not always equate to making more money. Often, the person who does the least wins the most. Whether you decide to be a trader or an investor, you must have a plan, understand the cost, and stay disciplined. None of this will work unless you start. The 30-year clock of compounding only begins when you invest your first dollar in the market. Whether you want to buy a single share of an index fund today or spend the weekend learning how to read a candlestick chart, the winner is always the person who takes action. So, are you more like Jason or David? Are you looking for the thrill of trading or the peace of mind that comes with long-term investing? Let me know in the comments below which strategy suits your personality better. If you want to see the exact index funds that David used to grow his wealth, check out our next video right here. Don't forget to hit the like button if this story helped you better understand the market. I'll see you in the next one.